Let's discuss joint operations and joint arrangements. So IFRS 11 joint arrangements deals with identifying whether it is a joint operation or a joint venture. If you have an investment in an entity wherein your investment in is 30%, the others are holding 25% and 35% each. It requires more than 50% voting right to take any decision. Is there any joint arrangement between these three investors? Alpha holding 30%, beta holding 25%, and gamma holding 35%. Is there any joint arrangement between these three parties? Is there any arrangement between them? They are collectively controlling it. There is a collective control of all the three parties, but there is no joint arrangement as of now. Joint arrangement is something when two parties get into a contract that we will vote together. Like alpha and beta decide to vote together. Alpha and beta decide to get into a joint arrangement. Alpha and beta decide to get into a joint arrangement that we will vote together. Now first we need to identify whether a joint arrangement exists or not between two parties. Joint arrangement is a contractual agreement between two parties that will vote together or will work together, or let's form a separate legal entity. First thing is to identify a joint arrangement. When we have identified a joint arrangement, we'll need to further identify whether it is an operation or a venture. Now, what is the difference between an operation or a venture? Operation is with your existing assets. You assume liabilities or you give away your assets to work on a joint operation. You do not form a separate legal entity. You are an existing entity which is getting into an arrangement to work together with a third party. That, okay, let's construct a road and I'll come up with material, labor, you come up with technology, machinery. Let's construct. The moment the road is over or complete, you go back with your machinery, you go back, take away your technology. I'll take away any material left, or I'll deploy the labor at some other place. We'll share the profits of the operation. But if you decide that let's make a separate legal entity, if two entities, if two or more parties decide to form a separate legal entity, and in this scenario, the venturers will have a right over net assets of that entity. In case of a joint venture, if one party bought the machine, when the work is over, they can take back their machine. One party bought material, if there is any material left, they can take back their material. Whatever they are providing as part of operation, they are owners of that component. But in case of a joint venture, the entity is the owner. The separate legal entity, suppose a joint venture named Alonso is formed, but Alonso has three venturers. Three venturers names are alpha, beta, and gamma, each holding 30%, 25%, and 35%. Now, Alonso is a separate legal entity. They do not have, in case of a joint venture, the venturers do not have right over individual assets and are not obligated individually. The entity has rights and obligations. So the role of IFRS 11 joint arrangements is to decide whether a joint arrangement exists or not. If there is a joint arrangement, we further decide whether it is an operation or a joint venture. If it is an operation, if it is a joint operation, the machinery which is part of Alpha's books, there is a PP recorded at 50,000. It will be depreciated and recorded and will continue to be part of Alpha's books. So this machinery is working on this joint operation, but it continues to remain an asset of the entity. It is not separate. It's already recorded as part of the books. We do not need to do anything. But if it is a separate legal entity, if it is Alonso's books, and if PP includes 50,000 given by Alpha into this venture as part of investment, Alpha will have to de-recognize this machinery as part of the books, and this machinery thereafter becomes the property of Alonso, becomes the asset of Alonso, and it cannot be taken away by Alpha as they wish, because it forms part of net assets. Now Alpha has right over net assets. They do not have right over this individual asset. Joint operation is dealt with line by line, that if there is a machinery provided by Alpha, it forms part of the balance sheet of Alpha. If there is a subsidiary, it will be added line by line. So has no relationship with the joint operation. Joint operation is simply an arrangement. Two parties come together to work together, they share the profit, and the profit will be recognized as part of their individual books. But if there is a joint venture, Alpha will simply recognize as a single line item share of profit from JV and investment in JV. Investment in JV Alonso. This investment in JV will increase by, so this will be forming part of P&L. And investment in JV will increase at the end of the year by share of profit from JV, and will reduce by any unrealized profit, if there is any, to the extent of share. I should mention, to the extent of share in JV, less impairment if any. So associates and joint ventures are treated in the same manner. Is the reason the standard is known as IAS 28. Now if it is a joint operation, IFRS 10 consolidated financial statements becomes applicable. If it is a joint venture, IAS 28 investment in associates and joint ventures become applicable. IFRS 11 is simply for identifying whether a joint arrangement exists or not, and if a joint arrangement exists, whether it is a joint operation or a joint venture. If it is joint operation, line by line, standard applicable is IFRS 10 consolidated financial statements. If it is a joint venture, then equity accounting, the standard applicable is IAS 28 investment in associates or joint ventures. Hope this is clear. Hello. Hope this is clear.
Amit, in case of equity accounting,
yes,
we also reduce the dividend received, right?
Yes.
So I think that line we have to add. Yeah.
Yes, we also receive the reduce the dividend received, because that reduces our total investment in the company.
Yeah.
It reduces our investment in the company, in the entity. And in the income statement, in the income statement, the line dividend income will be replaced by share of profit from JV. So Manoj, I've touched both the sides now. Hope it is fine.
Yeah.
So this is how we'll deal with associates, joint ventures, subsidiaries. Now, if I talk about income statement, I've already discussed the treatment of unrealized profit and intergroup transaction. So it's simply that we revenue, cost of sales, gross profit, administration expenses, finance, selling and distribution, taxes, net profit. So the parent and subsidiaries revenue, cost of sales will get added as P plus S. Revenue of parent will be added with revenue of subsidiary. If there is an intragroup transaction, that will be eliminated as an adjustment. So the accounting treatment will be, there will be an adjustment in the middle. So it will be, say, less 30,000 intragroup transaction. Less 30,000 intragroup transaction removed from both sides. If parent has a revenue of 400,000, subsidiary has a revenue of 200,000, cost of sales of parent 350,000, subsidiaries cost of sales 150,000. These two will be added, 400 plus 200 total revenue, because this is by third parties, less 30,000, 600,000 minus 30,000, 570,000 will be the revenue. 350 plus 400 cost of sales, 5 lakh minus 30,000, that is 4 lakh 70,000 is the cost of sales. Now, depending on how we have treated unrealized profit treatment may be increase here, add unrealized profit of 15,000, or it may be directly here in the gross profit adjustment less 15,000 unrealized profit, whatever the treatment. This is how we'll be dealing with the income statement questions. In the admin expenses, the questions will be very clear that depreciation and impairment will form part of cost of sales. So in that scenario, it will not be forming part of admin expenses below gross profit, it will be forming part of cost of sales. It may happen that the question may give you information that need to include depreciation or amortization as part of cost of sales. We have to be very careful in reading it. The finance charges may not have been dealt with. If you noticed here that there was an deferred consideration, if there is a deferred consideration, the parent will have to bear those finance charges. So there was a deferred consideration in the form of a liability in the balance sheet. So the deferred consideration will also have to be unwinded at the end of each year. That unwinding of discount will be presented as finance charges. If there is any contingent consideration, change in fair value contingent consideration, we increase the fair value. Any increase in contingent consideration will be forming part of the income statement. So both are interrelated. Any transaction. So all in all, the transactions which are happening in working note number 2 and 5 as part of income statement will be presented directly in the income statement. Impairment of goodwill, share of profit from associate or JV, unrealized profit on sale of goods, profit on disposal of machine, all will be forming part of parents side of income statement. Working note number 2, any transactions happening here, any depreciation charge, any unrealized profit treatment, any excess depreciation treatment, all these are happening in the income statement portion of subsidiaries side, and together we are able to present consolidated results of income statement. Once we have the profits, net profit for the year of P plus S, we'll have to divide it. It has to be attributable to parent as well as NCI. The NCI's share will be picked up directly from the information given to you, and any remaining will be the balancing figure in the parent. The NCI's profit will be the profit from the subsidiaries book. So we'll pick the figure not from the adjusted figures. We'll pick the figure directly from the subsidiary, and subsidiary's profit will give, a portion of it will give to NCI, and any balance will apply the percentage to profit belonging to NCI from the profit of subsidiaries books. And any difference from the total things, like we have calculated total after making adjustments of P plus S. Now from this total, if I remove NCI, the balancing figure will be from total, if we deduct what belongs to NCI, we'll be left with the balancing figure of the profit attributable to parent in the group. This will be the final treatment we'll be doing as part of the books. If you have any questions, any concerns, please ask. We'll do it in detail, balance sheet and P&L. When we do practice questions, we'll be able to fill up the gaps which exist as of now. But as far as principles, as far as consolidation procedures are concerned, I have shared all the principles as of now. If there's any doubt, please ask. So we'll continue doing some questions, some practice questions tomorrow. We'll do a question on balance sheet, we'll do a question on income statement, so that, and we'll also deal with how the accounting treatment is done for association and joint ventures in the practical questions. So we'll be covering through practical questions, one balance sheet question and one income statement question, so that this consolidation procedures get strengthened. So this is all for the day. If you have any queries, please ask.